And you are in charge of international program, right?
Right.
Can you explain a little bit for us how it works? Why is it important?
And how differs the traditional insurance and the global program?
Sure. So the key, I'll start with the second part of the question. The key difference is it allows a customer, typically it's going to be the risk manager, to negotiate their insurance by line of business just one time. So they work with an underwriter and a broker in their home country. So we're here in Sao Paulo. We have a customer in Brazil that's interested in an international program. They come to our underwriters at Corso. They work with them. The entire risk globally is underwritten by that single underwriter. That gives the customer the freedom to only have to negotiate their insurance purchasing once. The alternative to that would be take however many countries they have exposure in where they need to have coverage in place. They would have to then coordinate buying individual local policies in all of those countries. That takes a lot of time and resources that the risk managers of today, with everything they're being asked to do, they often don't have. So it helps them to coordinate their program, only have to do things once. It gives a lot of control over the risk management program of the entire company, because every country, every exposure that company has, they know that ultimately it's their corporate risk manager in the home country that's making the decisions, that's dealing with the insurance companies and representing the company as an entirety to the world and to the carriers that are providing the capacity for them. And the way that we make this work, to your question, is we do all the underwriting in the home country. There'll be what's called a master policy issued in that country. That's going to have worldwide coverage where it's permissible. But then we'll also work with our offices around the world. So the Corso offices that we have around the world, or partners in countries where we don't have our own offices. And we'll have what we call local policies issued for that company. So they have coverage in place in that local country, but they don't have to negotiate it themselves. It's already been pre-negotiated by the master. We take that administrative burden on of getting that policy issued, have the limits that we've agreed to, and all of the risk then is ceded back to the home country. And that's the other key part of it from the carrier side. It's you're not dealing with 50 carriers around the world. If you have that many countries, you're still dealing with one, because everything is going to be reinsured back to the home country. And that means that it's a coordinated and controlled program from the carrier's viewpoint as well. So it benefits not just the customer, but it can benefit the carrier.
Sometimes I think you may have some coverage, difference between countries.
Yes.
Is it covered by the master policy? I have heard about some clause GIC-GIL. I don't know if is it right. Is it possible?
It is, and you're exactly right. DIC-DIL stands for difference in conditions, difference in limits. So it's either of those two things. If the local policy is not as broad as your master policy, and you have a loss locally that for whatever reason is not covered, what we do is when there is a claim that happens on a local policy, we'll simultaneously open a claim on the master, and we'll adjust the claim as if it occurred on the master policy. So we can see if there's a differential between the policy language, whether it's purely a limit. If they have a $5 million limit for something on a local policy, but it's 50 on the master, they'll get that extra there. Or if it's a coverage that's not offered on the local policy, whether it's by regulation or just the breadth of the policy itself. What we want to do is, I talked earlier about the single underwriting of the risk and the single negotiation. We want the customer to know that what they've negotiated in their home country, that's the coverage they're ultimately going to get. And we'd like to have it on the local policy. We strive to do that. Some of our innovations that we've made really have eliminated a lot of the DIC-DIL because we issue essentially the same policy wording in most of our countries. So that helps to eliminate that. But the idea is that we want the customers to have the coverage that they've negotiated on the master policy. So DIC-DIL is one way that works. There's a somewhat new concept as well. I say new, it's probably 10 years old at this point, called financial interest coverage. Because what you find is a lot of countries around the world, they don't allow DIC-DIL. So if there's a claim that's not covered by their policy, it can go back to the master, but they won't allow a claims payment to come back into their country. Or if they do allow it, they tax it. as a capital expenditure from that company, so it gets heavily taxed, much more so than an insurance payment would. So financial interest gives us a mechanism to look at that claim, adjust it on the master policy, and the name financial interest comes from the fact that what we look to do is say the parent company that we're insuring on that master policy, they have a financial interest in a loss that happened somewhere around the world that we can't make a payment to them for. So what we're doing is we're paying for that loss to their balance sheet as a parent company. They then get paid in their home country for that claim. At that point, they can decide for themselves what they want to do with those funds. They can repatriate them to the country of the original loss. They can keep them themselves. They can do whatever makes the most sense for them. But it's a way for carriers to be able to fulfill that promise of providing the coverage that we've bound with them.
Yeah. On the other hand, I believe, I don't know, that sometimes, for example, we have this currency problem, dollar and real, for example, in our case, and the deductible comes
inflation
with dollar, do you receive a lot of complaints or try a different negotiation in different countries? Is it possible?
So there's a few things that we try to do. It's interesting when you get complaints because, of course, you only get them when the exchange rates go one way. If they go the other, nobody complains.
Yeah, that's true.
And what we tend to find is, absent extraordinary circumstances, if a government officially devalues its currency or something, then, of course, that's a different issue. There is coverage available for things like that. If it's just normal exchange rate fluctuations, we tend to see them balance out, where the positives are going to outweigh or balance with the negatives around the world. One thing that we do try to do to mitigate that is move the money as quickly as possible. So typically the biggest time that money is moving is when the customer is paying their premium. Of course, if there's a claim, but there's a lot of factors that go into adjusting a claim and the timing of which that's paid. So what we try to do, though, is get the invoice issued as soon after the binding date as we can, and then hopefully work with the customer to have them pay that invoice as quickly as possible as well. That way we're going to minimize the risk of those large exchange rate fluctuations. While, yes, the rates can change within as little as a week, but if you look at it historically, if we get things moved within 45 days or so of the time that we have all the last information to do it, there's not going to be a lot of movement in that exchange rate, and that tends to make everybody a lot happier. The other thing that we do see is we have companies that are more willing now to issue their local policies in the local currency. So for a long time, most policies were either done, most programs, I should say, so all the policies that allow it in either USD or euros, because that was the easiest thing for the risk manager of the corporate parent to deal with. But we're seeing now companies moving and saying if they have a local policy in Brazil, they want to have it in reais. That's what they want their local treasurer to have to pay their invoice in, so they don't have to worry about, well, when we bound this deal, it was this exchange rate to dollars, and now it's this one, so why do we have that change? So that's something that I'm seeing more of, and we tend to be flexible with allowing that where they want, and we can have a mix. You can have USD for countries that a risk manager chooses, and they can have local currencies for the other ones. So we do try to work with them on things like that.